Good day, great 12 learners. Welcome to today's business studies lesson. My name is Sidi Sotlaka. This program is funded by the Northern Cape Department of Education, broadcast by Pagama Research and Development. Today we look into two main topics, which is your business venture and business role, and we look into paper 2 difficult topic. At the end of this lesson, you should know the structure of your paper 2, main topics that are assessed there, and challenging topics, which is your investment security. Pre-knowledge, we looked into quality concepts together with the benefits of a good quality management. This is basically objectives to be covered when you're looking into quality. Then we also looked into how each function can contribute to the success or failure, and also looked into the business functions and looked into the total quality management elements, continuous improvement to processes, continuous skills development, adequate financing and capacity, and we also looked into monitoring and evaluation together with total client satisfaction. Now, terminology that is key for this lesson is the term shares. It gives a share gives now the investor an opportunity to obtain a part ownership of a company. And then dividends, this is a sum of money paid regularly by a company to its shareholders out of its profit. This is what we call returns. Ordinary refers to anything that has no special feature, and then preference share refers to a share which entitles the holder to a fixed dividend whose payment takes priority over that of the ordinary dividend. And then the structure of your paper 2, we have section A, which consists of your compulsory short questions. This is your multiple choice. This is your choose the correct word matching and the matching items, together with now the mark allocated there is 30. And then section B, you have to choose 2 from the 3 questions that are provided, which is your business venture from the question 2, your business role from the question 3, and question 4 is your miscellaneous. The total mark allocated there would be 80 because you choose 2 and each question is allocated 40. Then section C, you choose only 1 question. We have question 5 and 6 there. The mark allocation is 40 as well. Then main topics for paper 2, business roles and business ventures. Now, looking into the business venture, we addressed management and leadership. We also addressed investment security together with investment insurance, together with team performance, together with presentation, and together with forms of ownership. Then that is your paper 2, question 2, and then question 3, ethics and professionalism, creative thinking and problem solving, and the team performance and conflict management. So when you're looking into that, you also have here your social responsibility. And remember, your social responsibility is coupled with CSR and CSI. And you also have your human rights, inclusivity, and environmental issues. This was covered in term 3. This was covered in term 1. This was covered in term 1, and this was covered in term 2. Now, let us look into investment security. The critical aspect when you're looking into assessment of investment security is the investment opportunities. So you have your investment opportunities, and some confusion may occur, especially when you look into the forms of investment. We're going to look into those forms in the next lesson. So when you're looking into this area of investment security, the focus is on a investment opportunities, to say what should you know and how can they be assessed. Your investment opportunities and their risks can be assessed in this way. You should know what is now the Stokvel or mutual funds. You should know how to explain that, and also be in a position to explain the risk that is associated with this investment opportunity. So we call this your Stokvel, your managed portfolio, 32 days notice account, debenture, business venture, and life insurance. We call them investment opportunities. And then when you look into RSA, retail savings bond, unit trust, shares, and fixed deposit, we consider these to be the forms of investment, and you would be expected there to analyze the impact, which has to do with now providing the positives and the negatives of each form of investment. And you should know that you only have 4 forms of investment. So the focus of our lesson will be on the investment opportunities and their associated risk. So let us look into that. Now, the first investment opportunity is mutual funds or Stokvels. What do we mean by that? This is now an informal saving scheme to which relatively a small group of people contribute, and then it encourages people to save each month for a specific reason. And then the risk associated with your investment opportunity, that money in the savings account is safe investment, but it has low interest rate. It is safe, but will earn the investors low interest rate. And then schemers who claim to be running these mutual funds or Stokvels can actually be scammers. They can actually be scammers who claim to be running Stokvels, may actually be running illegal now pyramid schemes. Then we also have managed portfolio. I don't consider this to be an investment opportunity, but I consider it to be a way in which investments are managed. So when you're looking into management portfolio, it says now an investor instructs a bank or a financial advisor to manage his or her various investments in one portfolio. So this is to say now the investor already has investments. So they already have maybe 3 investments or 10 investments. So they're asking the bank to manage those 10 investments as one, so that they become one portfolio. So if the portfolio does not perform well or expected, the portfolio or parts thereof. So when you're saying parts, we are saying if one investment out of the 10 is not performing very well, therefore the bank or the financial advisor may be able to change with or without informing the investor. Then that is what we mean. The bank will be instructed to manage the various investments. Let's say the other one is on shares, the other one is on fixed deposit, and then let's say the other one maybe is on debentures. So basically, the bank would be managing all these 3 investments as one portfolio, and it can make changes. If some, let's say maybe an investment in fixed deposit or investment in shares is not performing very well, the bank may be in a position to make changes. And then what is the risk associated with this managed portfolio? It is lower over the long term or a longer period, and then the investments are made in various sectors or companies, and therefore the risk is spread and better managed by the portfolio manager. Then 32 days notice account, money is invested at a fixed rate, although withdrawals may be made provided that the bank is given 32 days notice of the withdrawal. It earns more interest than the current or savings account, but less interest than the fixed deposit. So this would be done via the bank. What is the risk associated there? Low risk, as the investment plus interest will be paid out on the maturity date of the investment, and the interest is calculated on the daily balance, accelerating the value or return on the investment and lowering the risk. Then we talk debentures. A debenture now is a tool that is used to borrow capital from the public. So this is done by the company. The company would be borrowing money from the public. So hence we say it is issued. So this certificate would be issued. What is the name of the certificate? Debenture. It would be issued to raise borrowed capital from the public. So the question for you should be, so what makes it an investment? It makes it an investment because now the company is borrowing money from the public. Who's the public? This is me, you, your grandfather, your mother, and your father. So when they are taking their money and borrowing the company, let's say they take their 50,000 and borrow the company has to pay them back the interest. And that interest now makes the issue of debentures to be the investor, especially when we look into the general public side, because the public will be borrowing the company money so that they can do whatever in their operations. So the lender or debenture holder agrees to lend. So who's the lender? This is people from the public. This is me and you. This is your mother and your father. So we agree now to lend money to the company on certain conditions for a certain period. The debenture holder or holders are creditors, as the company is liable to repay the amount of the debenture to them. And then most type of debentures can be traded on JSE, which is the Johannesburg Security Exchange, and debenture holders receive annual interest. So the holders, remember, is the general public. So they receive interest based on the terms and amount of debenture held. So when you look into it, you are having there a company, and this would be done by public companies that are listed on the JSE. So these companies would borrow money or would ask to borrow money from the public using the debenture. And then if the general public agrees to borrow that money, then the general public would receive interest. And we said this is annual interest, as you can check. And then until the agreed date to say their capital amount would be returned. So what is the risk? Debentures have low risk as they need to be paid back by the company, and companies are liable to repay the amount of debentures plus interest, which decreases the risk of the investor. So this is basically a safe investment. Then business venture or venture capital, this is when someone decides to invest in a business. So that is also an investment. So investment has to do with whatever that you put your money in and it brings a better income or a higher income, then we consider that to be an investment. So venture capital is given by an investor or a business to start up or expand a business. In return, to have a share in the new expanded business, investors should know the type of business or market or economic conditions before the business is bought or started. And then buying a franchise or an existing business would be successful if the investor has done proper research or understands exactly what he or she is investing in. Then the risk associated with business venture is that it can be higher risk for the investors if research is not properly done, because you might be investing in a business that is already running at a loss. And then inexperienced business owners that make wrong business decisions may experience big losses and closing down of an existing business. Then the last part is your endowment life insurance policy together with the retirement annuities. So when you're looking into that, this is basically a long-term type of investment whereby a monthly payment is made to the insurance company with the expectancy of receiving a predetermined amount on the date in the future, and to also provide for future expenses. So that is why individuals would normally take life insurance, because it provides for future expenses and gives peace of mind to the dependent of the insured. Then the risk there is low risk, as the insured amount will be paid out regardless of the circumstance, and only the closing down or bankruptcy of the insurance company may result in losing the monthly contributions made up to close date. So that is the risk associated with this investment opportunity. Now, summary of our lesson: we looked into the structure, we also looked into main topics and the challenging topic, which is your investment security. That was part one, but we'll also look into the forms of investment and look into the entire lesson on investment securities, because it's very, very critical, especially for this year's final exam. So thank you for watching. Keep well. Goodbye.